Good afternoon, and welcome to the June Housing Market Update. This is Alex Fenske, your team leader here at Keller Elite, and I've been nerding out here for a little bit to get some facts and some truth about what's going on in the marketplace, and particularly what's changing, how fast, what isn't changing. I personally was very interested in the results here because there's a lot of talk in the agent community going on about this shift and all this stuff. And I just always am seeking the real truth as opposed to maybe, my own experience or one other agent's experience, which can vary widely based on all the specifics about us and our business. So I got the real numbers for you on everything for May. And I think it's really interesting. So what we're going to do is we're going to cover our key metrics for our real estate market data. And then we're going to touch on mortgage and economic conditions. And we'll leave you with a few nuggets, some small little factoids and messages that you can share with your clients so that you can just sum up everything that we're talking about here today. So with all that said, let's dig in. And by the way, interactive. So as you're listening, drop comments in the chat if you have any questions or comments or what have you, and I'll keep an eye on that. So number one, we're looking at the number of new listings. And actually, we are continuing a trend here, or a pattern, that new listings are down 10% compared to a year ago. Now, new listings have been down about 10% or more, actually, for all year. All year, new listings have been down. So that trend continues. New listings were down, year to date, are down 12% compared to year to date at this time last year. So if you look January through May, 12% fewer homes have come on the market. It's definitely a difference. It is not an earth-shattering difference. And it actually has been matched by the changes in demand. So we'll go there in a second. But new listings are down 10% month over month, 12% year to date over prior year. It's actually the lowest number of new listings in any May going back to 2012, excepting May of 2020. That was still when COVID was very new and new listings had not gotten to a normal level yet. So other than May of 2020, this is the lowest number of new listings in any May in the last 10 years. Next up, pending contracts. This is how we measure buyer demand, right? That's new listings are the number of new sellers entering the market. Contracts are the number of buyers that are writing contracts on those. So those are down 13%. Actually, it's 13.6% compared to May of last year. A pretty similar drop compared to the number of listings. Now, last month we talked about the market thinning, meaning sellers go down, buyers go down. The relationship between the two is still the same. That's what we're seeing happening. New listings are down 10%. New buyer contracts are down 13.6%. They're pretty close numbers. In terms of the number of contracts, though, a lot of people are saying, oh my gosh, it's slowing down. The number of pending contracts this month is basically identical to the number of pending contracts in May of 2019 and 18. So it obviously is lower than it was in 21. May of 2020 was a crapshoot. That was early COVID. It's about the same as it was within a couple hundred units for our whole MLS in May of the prior 2 years, 2019 and 2018. So it's a bit more what you might call normal. That's pending contracts. Inventory, the number of total homes for sale. Normally, throughout this time of year, inventory is climbing. So that is expected. And normally between April and May, so from April to May, we typically see an increase of between 3% to 8% inventory growth from April to May. We only saw a 2.75% increase in inventory from April to May. Now, once May numbers are adjusted after a couple more weeks pass, that number may climb a little bit. Long story short, though, is we're probably going to land on the very, very low end of normal in terms of the number of homes for sale increasing from April to May. It's going to be about normal. Imagine that. Now, that's the growth from April to May. The total number available is still by far the lowest May on record. Down 26% from May of last year. Yes, the number of homes available is lower, than it was May of last year. That may come as a surprise, not by a little bit either, 26%. For every 100 homes that were on the market in our MLS last year, there's only 74 right now. And that's because new listings have been low. And so that's continued, even though buyer demand has softened a bit. New listings have softened too. Still, lowest May on record by far. Months of supply. This is a great metric that I talk about all the time because it factors in, it takes into account sellers and buyers. And so it's a bit more holistic look at the balance between the two. Now, the months of supply changed very, very little. We went from 1.2 months of supply to 1.4 months of supply. It's still lower than any other month on record prior to the past 6 months. And it's still very, very, very much a seller's market. As a quick reminder, 6 months of supply is considered a balanced market in which there's no pressure on prices up or down. They're going to be flat. That's 6 months of supply. We went from 1.2 to 1.4. It barely moved. And again, prior to the last 6 months, a number anywhere in this range has never been seen as far back as our data goes in our multiple listing service. So that's one thing that really hasn't changed much. We're still in a drastic seller's market, even though it may not feel like it because the number of transactions dipped and also because of some pricing changes, and we're going there in a second. Still very much a seller's market. So let's talk about prices. Monthly price changes, pricing happens a lot seasonally. There's typical seasonal fluctuations. And normally from April to May, we see prices go up between 1% to 2%. It's pretty consistent. This April and May, pricing looks like remained flat. So instead of going up 1% to 2% like it normally would, it just stayed flat. Why? Well, I think we all know that. It's because mortgage rates have skyrocketed. So that has put a dent in buyers' buying power, and they weren't able to offer as much as they maybe normally would. If you look at the seasonally adjusted median sale price, when we say that, we mean we take a 12-month average. So every number accounts for 12 full months, which allows you to include all the different seasons. So when we say seasonally adjusted, that means a 12-month rolling average. The 12-month rolling average has been pretty flat for the last 3 months, which, if you remember back, mortgage rates first jumped up. They began rising in the very beginning of the year, but really late February is when they really started to pick up, and then they really rose fast after that. And pricing has been pretty flat for the last 3 months, so from March, April, May. That's still up 7.5% from last year. So annual appreciation wise, over the last 12 months, you're still looking at 7.5%, which is more than we would often see in our marketplace anyway. So it certainly isn't the outrageous boom that we saw last spring and summer, where prices were rising at an annualized like 40%. It's not like that at all. Prices have really cooled off, and you're probably from here on out looking at mid-single-digit annual price increases. What's really weird, though, is that could even happen when there's only 1.4 months of supply. So when there's that little supply, that means there's a lot of buyers competing for scarcely available homes. And when they do that, they compete with primarily one tool, price. So when they compete with price for scarce properties, and they raise prices. Somehow we're in a market where there's only 1.4 months of supply, but prices are not skyrocketing. So again, just because of that rapid increase in mortgage rates. So that's kind of interesting. It's different than what you would expect in a market with that little supply. Speaking of mortgage rates, today's average 30-year fixed rate mortgage is at 5.09%. That's actually down a little bit from its peak of 5.3% a month ago. And so they moderated a little bit. I would not expect them to go down over time, not by any large margin. In fact, some of the economic forces at work are going to continue with upward pressure on mortgage rates. Yes, I think they're going to go up more from here on out because of what's just begun this week. So That's going to bring us into our economic conditions portion of the update here. With mortgage rates standing at 5.09%. Economic conditions, there's some really important stuff happening here. So number one, the Federal Reserve began this past week, winding down their $9 trillion balance sheet. So what that means is that, the Fed has assets. The Fed, as a bank, it buys things, primarily bonds, treasury bills, mortgage-backed securities, things like that, and some other things. During the COVID era, their stimulus, if you will, it's called quantitative easing, where they go out and buy a bunch of bonds and mortgage-backed securities, which injects cash into the marketplace and creates demand for those products, which is why mortgage rates dipped and everything. They ended up buying about $3 trillion of mortgage-backed securities, which is when the banks write the mortgages and then go package them and resell them, so they can go make more loans. The Fed bought nearly $3 trillion of those through COVID, and the same amount, nearly $3 trillion in treasury bills, which are closely related to mortgage-backed securities. So $6 trillion of their $9 total balance sheet is stuff that directly impacts mortgage rates. Starting last week, they are now selling those. So they were buying them, which was lowering rates, and they just now started selling them. And they're going to be selling them at an average pace of $95 billion per month. And I saw their update. I think it's 96 billion this month that they are scheduled to sell. So that's why I say, and I'll nerd out on bond yields and all that stuff in some other time. That's a longer call, and only the true nerds will want to watch that one. But this sort of monetary policy is going to put upward pressure on mortgage rates. Another little bond nerd thing, the 2-year, 10-year Treasury yield curve inverted briefly in April. Historically is a very accurate predictor of an economic recession within 18 months. So what we're looking at, there's probably going to be some form of economic recession after the second quarter of 2023. Are we saying the world's going to collapse? Not at all. Recession just means that total GDP retracts a little bit. And that probably will happen if this indicator is correct. That doesn't necessarily, as we've learned in the past, doesn't necessarily mean bad things for the housing market, but it's important to know. Lastly, inflation is a big topic right now. The rolling 12-month inflation rate ending in May was 8.3%, which is outrageously high. The Federal Reserve Open Market Committee meets next week, and we'll find out what they're doing with the overnight borrowing rate, which gets a lot of media attention. That originally they were saying that they were going to raise it again by another 0.75 points, 75 basis points, which kind of had the markets freaking out because the more aggressive action they take, the faster and harder they send us into a recession. And so in an attempt to get a soft landing, they're going to ease back on that. Looks like they're probably going to raise the overnight borrowing rate by 50 basis points or 0.5%. Again, that doesn't directly impact mortgage rates, but it does impact the overall broader economy. So that's what's going on with the economy. Some important things to know about the longer-term outlook and the forces that will likely continue putting upward pressure on mortgage rates. So here's the best part of the call. What do you do? What do you tell people? What do you say? As people are saying, how's the market? I hear things are changing. Is it a shift? What's going on? Well, number one, I think we can make it simple for our clients by telling them what has changed and what hasn't. So what has changed is the number of transactions is down off its peak. It's 10 to 15% lower than what it's been recently, which is just going back to more normal levels. And also what has changed is that price increases have changed. The price, the outrageous rapid appreciation is that's probably gone. It's probably done, and frankly, it needed to be. Affordability was just going nuts. So the price increases have absolutely changed. That has cooled down a lot. And no, nobody's talking about a negative pressure on prices. Prices going down. Nobody's saying that. That doesn't appear to be what's happening. But certainly in the single digits is where we're at. And what has not changed, it's still definitively very, very much a seller's market. There are still way more buyers than sellers competing for scarce listings. It's showing up differently because they don't have the extra 30 or 40 grand in their pocket to bid the list price up, because their mortgages cost them 5.5% instead of 3%. So there's still a lot of competition, but buyers are more limited on price because of the mortgage rates. So that's I think what we can tell them. Sellers, what should sellers do? Number one, we should be telling our sellers, you've probably captured the bulk of the price appreciation you're going to get. It's going to keep going up, but nothing like it has. I mean, people have been checking. You can check your value every month on whatever your favorite website is and keep seeing it go up. It's not going to be happening like that anymore. So I think it's important for us to let our sellers know that this is not like, hey, wait another 3 months and it'll be worth 30 grand more. I think we're done with that. They might want to take advantage of the current market, because while the price rage is over, I think, the seller's market is not. There's still a lot of competition, and listings are still scarce. Over time, that will change. It looks like that's going to be moving pretty slowly. Buyers, what should buyers be doing? Well, they kind of missed the boat on the super, super low rates, but it's still pretty cheap to borrow money at 5 anything percent. And we do project, as I just got finished saying, that prices are still going to keep going up by single digits, and mortgage rates we expect are going to keep going up because of the monetary policy that's got to be enacted. So what does that mean? Prices going up, rates going up, not like they have, but still going up. So a home is still going to cost you more tomorrow than it costs you today. That is still the case. And it's still going to cost you more to rent a home than to own one of an equivalent nature. So it actually still is in a buyer's best interest to buy something now. Sellers probably have a little more time on their hands to be able to sell something. I don't think we're on the verge of a cliff or anything like that. Nothing indicates that. But that's what I would be telling our clients. That's what I'd be telling our sellers and buyers. I'm looking now to questions. And I see Dave's got a question. 8.3% seems low based on the cost of goods and services. The reason buyers are not applying for loans or sellers refusing to sell. So the sellers refusing to sell thing, we believe, is primarily because of the lock-in effect. Meaning, if I have I can tell right now, I have my mortgage on my house is like 2.375%, 15-year mortgage. I couldn't come close to touching that. I mean, I probably couldn't even get double that rate right now. So I would be less likely to sell my home, because in addition to having to go through the normal process of finding one and putting the money down and and incurring all the costs of moving and buying and selling, I'm actually going to have to give up my 2.375% rate and get a 5.375% rate. So that looks less attractive, and that's called the lock-in effect, and that's what happens when mortgage rates rise. So that likely has got a lot to do with the lower listing inventory, not the inventory, but the lower number of new listings. And then a reason buyers are not applying for loans, well, certainly part of that is interest rates. Does that got to do with inflation? It might. I mean, if a lot of people are feeling the differences, particularly with energy costs, and so they might say, hey, we were going to apply for a loan, but now we're not. And so that probably has something to do with it. More directly, it is the increases in mortgage rates, and we know that that's going to have some kind of effect. But I will tell you, go look back at any point in history when interest rates were far, far, far higher than what they are today, and you'll see there can still be extremely robust and even high or even excessive buyer demand, even when mortgage rates are higher than they are now. They averaged about 6% through the boom leading up to the crash. Now, granted, there was a lot of unhealthy things going on in the mortgage market at that point, but nevertheless, rates were like 6%, and there was lots and lots of people buying homes. So I'll go back to my thing about mortgage rates don't cause people to buy. They can add fuel to it, but people buy and sell homes because of life changes. Household creation, household destruction, aka creation being birth, marriage, destruction being death, divorce, things that bring families apart. Empty nesters, job relocation, retirement. Those are the reasons that people buy and sell homes, and those don't change when interest rates change. Interest rates do change affordability. They change how much someone can pay, and they can have a modifier effect on if someone is on the fence. That might sway them one way or another, but they don't cause people to decide whether or not to buy. And as far as the number 8.3%, who am I to question the St. Louis Fed? I don't have that sort of research to know what goes into that. That is a 12-month rolling average, though. So with any kind of 12-month rolling average, if it was lower for 6 months and then higher for 6 months, the average would be in between. So I don't know how it looks or if the data is out there to take a single month inflation average. I'm sure they track that stuff. That's how they come up with a 12-month average. But the limits on my economic prowess are here. We've met them, so I can look stuff up and gain some understanding. But ultimately, if you want to dig in more on the inflation, my data source for that stuff is the St. Louis Fed. They got a really good website that portrays a lot of really good information. It seems pretty easy to find. So, any other questions? Any other questions, comments, concerns? Yeah, the rolling average. That's why, Dave, when I do these market updates, I lean really heavily on the single month data because 12-month rolling averages, while they do include seasonality, they can hide changes that are happening on a monthly basis. And so I like to look at the single month average unless we're talking about things that involve seasonality, and then I'll take a 12-month. Anything we should be adding regarding pricing strategy for sellers? Yeah, Ruben, good question. So, long time ago in the real estate crash, we used to take a look at the recently closed comps and go, okay, well, you got to be below those because prices were going down. In the recent couple of years, we've been doing the opposite. We've been going, look at the closed comps, and because if it closed a month or two ago, that means that the contract was written on it 2 to 3, maybe even 4 months ago. That's a lot of time to pass. So what we've been doing for the last couple of years is going, look at your comps from 2 months ago, and then just round up, add a few grand, add 20 grand to it. Pick the next highest round number, or maybe you're not looking at the comps at all, and we're just throwing darts at a board. I don't think you can do that anymore. And I have heard I've heard of more people saying we needed to do a price change, things like that. So I think what we need to do is we need to tighten down the way we're having conversations around comparable sales, and we need to not be pricing above the comps. We really need to return to, if you ever left it, pricing to the comps. We don't need to price below them, but we can't just be doing all right, all these comps average out to 328, so let's go 350. That's not going to work anymore. At least it shouldn't. But I've been proven wrong a lot of times. It doesn't look like that's going to work. So, Ruben, that's what I would be doing with pricing strategy. And if you got one that's priced optimistically, may need to dust off those price change scripts. We got some if you need them. Any other questions? Questions. Going once, going twice. If you post them, I'll go back and reply to them later as I see them. And I wish you luck. Check in if there's anything that we can help with or any information that I can help you find.